In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the tech IPO boom rolls on. Pinterest and Zoom Video preparing for their trading debut. But will investors hit the brakes or move full speed ahead after Lyft's lackluster debut? Plus, the Apple-Qualcomm settlement could have big implications for the 5G race. Will the iPhone maker now have an upper hand to bring a 5G device to market? And FOXCONN founder TAIWAN announced he's running for president of Taiwan, saying he's following the call from a Chinese sea goddess. If he wins, where does that leave his company? But first, to our top story. 2 more tech unicorns are heading to the public market Thursday. Social media discovery company Pinterest and video conferencing platform Zoom, both expected to price their shares Wednesday, joining a rush of tech companies slated to go public this year. According to the Wall Street Journal, Pinterest is targeting $19 a share, $2 above the high end of the range, but unlike some of the other big names making their trading debut, Pinterest and Zoom are burning through less cash. Pinterest could see revenue more than triple by 2022. Meantime, Zoom is a rare type of unicorn, a profitable one. Joining us to discuss, Triton Research CEO Rhett Wallace and Bloomberg Intelligence Senior Analyst Jitendra Wawal. So, Rhett, I'll start with you. What are the prospects for both Pinterest and Zoom as you see them?
Well, I think let's start with Zoom, because Zoom, as you say, is something that we don't see very often, which is a company that actually has EPS, like earnings per share. So that's obviously very good, but it's also got fabulous growth, and it's already at scale. Often when you see companies with this kind of growth rate, they're still really small. So everything that we see when we look at Zoom and everything we hear when we talk to people at Zoom is that it's going to be a rocket and will price above its range and trade way up tomorrow. As far as Pinterest is concerned, it's fine. It's great. I mean, our score on it was sort of a little bit above average. When you compare it to Snap and look at its loss ratio, it's sort of on its way to break even on the EBITDA line. It's got user growth, which Snap doesn't have, and it's already got a scaled audience. So what we're hearing is also that deal is in fine shape and will price at or above the range.
That said, Jitendra, Pinterest is doing a sort of flat round here. I mean, it was aiming for a valuation that was below what it raised at in the private markets. Is that smart?
Yeah, I think given what we saw happening with Lyft, and also if you just look at history of key internet IPOs, the first 6 months, the first day craziness has been pretty consistent, and the volatility has been there. At least they are setting their expectations in line with what they can deliver on growth. So if you look at the growth prospects of this company, like you said, you know, if they are able to jump over these near-term hurdles that they have, they could triple their revenues in the next 4 years.
What are the near-term hurdles?
So there are 3 basically. So one is how they scale their revenues right now. So self-serve platform, the automated buying platform that they need to scale revenues quickly is still nascent. They're still depending on Salesforce sales team chasing few large advertisers. So it'll take about a year to sort of transition to that. Snap already has. Then you have Google de-indexing, you know, key landing pages for Pinterest. That affects user growth. It happened like 1Q of last year, but that might play a role over here. But the main thing over here for Pinterest is the average revenue per user is about $3 right now, compared to Twitter, it's $8. So there's a lot of room to take this purchase intent that the buyers have and sort of like push advertising in front of retail audiences.
Now, Rhett, Pinterest has interestingly been trying to distance themselves from social media. So what is Pinterest? Is it like social commerce discovery? I mean, what bucket would you put this in?
Well, I think that, you know, the way I would define it is, you know, social is requires somebody else on the other end of the network to interact with you. And you can interact with Pinterest without that. Pinterest is a way to interact with the world as opposed to interact with other people. And so I think that comparison is actually fair, that the content doesn't come from other users, it comes from the internet at large. Obviously, for all kinds of reasons, there are, you know, it's obvious why somebody would not want to be called a social network right now at this point in 2019, so that also makes sense.
And Jitendra, are risks around privacy, is that a concern for Pinterest? Misinformation? You know, an ad-based network, which has maybe a different incentive structure than one.
Well, because as the point was made, that because the content is not user-generated per se, everybody's just making their wish list, things that they would love to buy down the line. And if you look at the searches on the platform, which is going to become a key metric for this company, most of them are unbranded, so they don't know which brand to buy. So basically, you kind of marry like this repository of things that I would love to buy to brands that would love to sell to them, and that creates a unique story where it's more about user engagement, less about user growth, and that revenue growth metric could be sustainable because of that perspective.
So, Rhett, let's talk a little bit more about Zoom. Who
Sure.
are the main competitors in the video conferencing market? I mean, you think about legacy players like Cisco, like QUALCOMM. Who is Zoom potentially unseating here?
So that was one of the reasons that Zoom scored as highly as it did with us is, from the perspective of new companies as opposed to, the kind of old Cisco platforms like you mentioned, they kind of own the space. Like Zoom meetings are a thing, so it's a little bit like Ubering. I'll send a Zoom invite. Means that they've sort of taken it a little bit like Skype did. So one of the things that we like about their differentiation is they seem to have that category sort of to themselves. As far as a business is concerned, we think it comps to DocuSign pretty clearly. It's going to be a little bit more expensive than DocuSign, but I guess the growth and the profitability sort of make that make sense. But you should have the space sort of to yourself unless one of the big guys like Google decides to give this product away.
Both of these companies are looking at a $10, maybe $12 billion valuation. Do you think there's going to be competition between them on the day? I mean, are investors going to be attracted to one or another? Could there be some sort of split?
It seems like investors like to make money, and so there's room to buy both. Right, so I mean, again, everything that we're hearing is that these deals are both in great shape, that Zoom will trade very, very well, but investors basically like the Pinterest story. And I think, obviously this came up, but Pinterest is really priced right. I mean, when you look at what Pinterest is doing relative to what Snap did, Pinterest is raising, half as much money with twice as much revenue. So it's a very, very attractive valuation story, and the trading dynamics should be good.
It may appear to be priced right, Jitendra, and we saw Lyft, go above its pricing range as well on the initial trading day, huge first day pop, and now shares are below their IPO price, significantly below their IPO price. I mean, could we see that same thing happen with Pinterest, where there's this perception that the price is right, but then,
Right.
A few days into it, investors change their mind, or there's a lot of short interest, or something else?
Absolutely. So, if you see the history of key internet IPOs over the decade, this happened to even profitable companies, Facebook, Alibaba. So first 6 months is more a function of things like you said, supply and demand of stock, what's the lockup periods look like and things like that. So yes, the volatility could happen. But if they are able to sort of jump through this, deliver good results in the interim, they can sustain the high valuation.
Now, Rhett, you were one of the analysts, the first analyst that came out fairly critical of the numbers that Lyft was pointing out, saying there wasn't enough to make a complete financial model. Now that you see what Uber has put out, do you think that Uber will suffer from the same problems as Lyft, or do you think it's a completely different story?
Well, so, I mean, what Lyft did was, to some people kind of offensive. Because I think when you're losing $1 billion on the EBITDA line on $2 billion of revenue, you kind of have an obligation to explain to investors how your profitability story is going to improve. Uber is losing $3 billion on $11 billion of revenue and is obviously a much bigger company. I think their disclosure was better than what Lyft put forward. Obviously, the detailed metrics are much more significant than what we heard from Lyft. They broke out bikes and scooters, for example, among other things. But still, I think price is going to be a very important factor in how the Uber deal is perceived.
Interesting. Well, we'll be watching for that for sure. Rhett Wallace of Triton Research and our very own Jitendra Wawal. Thank you both.
Thank you.
Well, investors are cheering Intel's decision to hang up on the 5G smartphone modem business, sending shares toward their highest level since the dot-com boom of 2000. Apple's settlement with Qualcomm means Intel lost its one significant customer in the 5G smartphone market. That is Apple. Intel said it will wind down its multi-billion-dollar bet on 5G, but it will look at whether existing chips and 5G modems can be used in personal computers. This was going to be a costly bet for Intel, so investors cheering that they don't have to spend that high price. Coming up, shares of Qualcomm surging after its legal settlement with Apple. What does it mean for the rest of the chip industry? Next. And if you like Bloomberg News, you can check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Qualcomm shares jumped 12%, continuing a two-day rally of about 40% after announcing a settlement with Apple and signing a deal for royalties and chipsets to end a bitter legal dispute. The agreement could be a big deal for the entire chip sector, raising hopes of a 5G iPhone in 2020. Joining us now to discuss, we've got Anand Srinivasan, a senior analyst at Bloomberg Intelligence, and on the phone, Stacey Rasgon, an analyst with Sanford Bernstein. So, of course, Anand, this leads to many questions about what happens after 6 years. That's the term of this agreement, and also what does it mean for the rest of the chip industry, given that this licensing model has been frustrating not just for Apple, but for other manufacturers as well.
I think that's the big takeaway for us from this, more than the monetary settlement, is the fact that Qualcomm's business model as an intellectual property licensor is validated, and the fact that its IP can now be monetized well beyond the value of the chipset itself through the value of the device. And I think that when you get somebody like an Apple to validate that business model, I think that's a pretty strong statement. So that's the big takeaway for us from this, even beyond the economics of it. In the grand scheme of things, we believe that Apple is on its way to build its own modem. The question is, how far will that be? What will the economics of that be, and what will the royalty structure be after that, etc. Is to be determined. But this is we always thought that Intel was a placeholder for Apple, and that with 5G, Qualcomm regains its placement back in the iPhone, but in the long run, it's going to be an Apple cellular baseband chip in there.
So, Stacey, what's your take on how good a deal this is in the short term and the long term?
Yeah, you bet. So look, this is a stock that has been viewed as virtually uninvestable by most investors for going on 5 years now. And if you actually look, the stock is, even year to date, it's only up in line with the rest of the sector even after the run. And over 5 years, it's actually down. Like, let me know one other semiconductor stock that's down over the last 5 years. So this is huge in the sense that with the legal overhang gone, like, fundamental investors may actually be willing to do some work on it now, which has not been true for many years. At the same time, there's a lot we don't know yet. The company guided about $2 eventually in upside from this deal. We don't as yet know how that $2 in earnings splits out between licensing and chips. It does seem like they've validated the model in terms of royalty on the device space, but we don't know what the actual dollar royalty is. I guess we'll find out. And then I think to the point I heard earlier, the chipset agreement, how long does it stay with Qualcomm? The licensing agreement is 6 years plus maybe a 2-year extension. The chipset agreement, they were a lot less specific. They just said it's a multi-year, and they didn't give any numbers. So that sort of brings up the question of what Apple's plan might be, 3 years out. Obviously, Intel's not around right now, but in 3 years, the overall competitive environment will probably be tougher than it is now, and we'll see how far along Apple is on their own efforts at that point. But for now, if we've got a few years runway, investors may want to buy this. My guess is it will probably continue to grind up into earnings, which is in a week or two. And then Qualcomm will talk, management will talk, and then we'll see what they say and what they don't, and that'll probably determine where the stock goes from there.
Now, Apple, we know, Anand, has been focusing on making its own chips. What do you think Apple's game plan could be longer term?
Look, I think that if you look at the value of the chips within the iPhone, the application processor, which is homemade, if you look at the motion coprocessor, that's homemade. The Wi-Fi chip is still third party. The cellular baseband chip, which is both from an important standpoint very high and a reasonably high dollar value, that's also externally sourced. So I think that to some degree Apple wants to control the elements that are high intellectual property and also determine the cadence with which it can launch critical new features in the iPhone. But at the same time, it doesn't want to necessarily make commodity chips or have any control over that when it can be quite easily and cheaply purchased from third parties. So I think that's the weighing decision that Apple might use to determine whether it wants to make those chips in-house or it wants to source it from third parties. I think control and cost are key elements of that. But Stacey makes a great point, which is that just because this deal is done and Qualcomm becomes an investable name again, it's not like all the problems that the underlying market is facing are suddenly relieved. The handset market, all is not hunky-dory right now in that market. So, it might be hitting a sort of a threshold of unit growth and sizing and saturation, et cetera. And Qualcomm is disproportionately biased to the handset market as much as they might try to expand their presence in other devices. So, there's some good with the bad. I think this provides an incredible sense of relief to investors, but it just doesn't take away all of the issues with the underlying market.
Now, Stacy, I find it curious that Qualcomm still has such a stronghold on 5G technology. I mean, do you expect that to continue, that there will be no other company that can do it as well as Qualcomm?
No, I mean, even today there are other companies that can do 5G. We have Samsung who's shipping modems today. We've got Huawei, MediaTek as well. Intel obviously exited. They're only the last in the long line of folks to exit. But Qualcomm certainly is in the lead, and that is true. I mean, they were even in the lead on 4G. But you have to remember, like on 4G, like things were very good at the beginning of that cycle for a few years, and then it collapsed as the competition became good enough. 5G, we may see something similar. Again, it's probably a few years, but eventually, I don't know that anybody will ever be better than Qualcomm, but at some point there's always a line that is good enough. I think there's one other difference between 4G and 5G. With 4G was basically the reason to go out and buy a smartphone. And so not only do we get a good amount of ASP upside as that transition happened, but we also got a ton of unit growth. With 5G, I don't know that we get that. I think that the smartphone market at this point is relatively saturated, so I have a feeling 5G will be more of a replacement market than 4G was. To me, that means the upside for Qualcomm as it comes from 5G is probably from chipset content and chipset ASPs rather than tons of additional unit growth. Like once we have Apple back into the mix and the baseline is set, I don't know that we get the kind of unit growth that we saw over the last cycle. So that's one difference.
All right, Stacey Rasgon with Sanford Bernstein and our own Anand Srinivasan, and we'll be watching to see how the chip industry responds. Coming up, TikTok's time in India may be up. Why an Indian court is blocking new downloads of the controversial app. Next, this is Bloomberg. Google and Apple have complied with an Indian court order to block downloads of the popular app TikTok. This after the government voiced concerns with illicit content on the app. This move could handicap its owner, China's ByteDance, in one of the most promising markets. For more, I want to bring in Bloomberg Tech's Mark Birkin, who has been reporting on this story. So interesting that the Indian government has intervened here, whereas other governments have not, in an app that's been concerning to a lot of people because, you've got a lot of children on this app performing, lip syncing, and concerns about sexual predators.
Yeah, I mean, it's interesting on multiple levels. In many ways, we've seen this, and we've done some great reporting out of Asia, that India, like other countries in Asia, are adopting more of a Chinese model of regulating the internet. So they're becoming a little bit more severe. Some would call it draconian. And they're going after, India does have a fairly conservative-leaning politicians, and so they're going after a Chinese company right now who has made this big push. They claim to have 120 million monthly active users. They've just grown gangbusters, and one of the few tech companies in China that has actually done pretty well outside of China. They have a huge and growing presence here in the U.S., and they also, this is an AI company that sort of prides itself on its ability to take down content pretty quickly.
ByteDance has said the case is still ongoing to date. We have faith in the Indian judicial system, and we're optimistic about an outcome that would be well received by over 120 million monthly active users in India. I mean, the concerns are really disturbing. Concerns about dangers to children, claims about porn, exposure to sexual predators. how is this different than what you might see on YouTube, where a parent can upload a video of their child and who knows what happens to it?
Yeah, well, YouTube will tell you that no kid under 13 watches the videos according to their terms of service. So there's right now Musical.ly, which was the app that became TikTok, had a record fine from the FTC around collection of children's privacy concerns. So there is a bit of a drumbeat, and the same sort of advocacy groups are asking for lawmakers to look at YouTube in a similar way.
I also want to ask you about the Notre Dame situation. Obviously, a devastating story. Watching Notre Dame, getting essentially burned out, and in the middle of that, on YouTube, this text box pops up that labels the burning of Notre Dame as 9/11.
Yeah.
What happened?
Yeah, YouTube's just said they said it was an algorithmic wrong call, which is interesting phrasing. But I think, what best we can decipher, this is their image recognition technology that saw a picture of a burning facade and sort of the software determined that it looked like an image of 9/11. And so this is something
that could be lots of burning facades.
Totally. I think, there's a lot of cases where YouTube over the years, the past few years, has been hammered for pushing conspiracy theories like 9/11 was an inside job. And so in this case, this is a precaution they're taking. I think it goes back to the point here with TikTok too. ByteDance is this Chinese company that's prided itself on its artificial intelligence. Google is arguably the world's leading AI company. AI is not quite there at solving this problem. And both companies will point to their scale as saying they can't have humans look at this. YouTube has now said this morning, 500 hours uploaded a minute. And so even if you had humans looking at that, this is clearly an interesting case where it's a breaking news event. You'd think that someone in the company would say, let's look at all the videos around the Notre Dame fire, because this is where a lot of people will be drawing attention, but they're still relying on machines and software right now.
Right, and it's having to find that balance between what machines can do and what humans can and should do. Okay, Mark Bergen, who covers YouTube for us, thank you so much for that update. Coming up, Netflix reported an underwhelming second quarter forecast, but CEO Reed Hastings says he's confident new services from Disney and Apple will not slow their momentum. We'll discuss next. And Bloomberg Tech is live streaming on Twitter. You can check us out at Technology and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. Bloomberg Technology, I'm Emily Chang in San Francisco. Well, Netflix may be paying the price for raising the price. The streaming service predicts it'll add just 5 million new customers in the current quarter, which is well short of Wall Street forecast. Netflix blamed the slowdown in part on raising prices in the U.S., Brazil, Mexico, parts of Europe. Then there's coming competition from new streaming services from Disney, Apple, and Warner Media. Joining us to discuss, Nick Nelson in L.A. He is OWN's Entertainment Head of Product Innovation and the former Head of Product Creative at Netflix. Also with us, Geetha Ranganathan of Bloomberg Intelligence in Princeton. So Geetha, 24 hours later, what are your thoughts on the Q2 forecast combined with the comments from Reed Hastings that, momentum is phenomenal and this coming competition won't be that much competition because there's already competition?
Yeah, absolutely, Emily. So, as you mentioned, yes, the subscriber guidance was slightly disappointing. But then if you factor in the seasonality impact, if you factor in the churn, as well as the fact that there's a little bit of a limited content slate in 2Q, I don't really think investors have too much to worry about. Netflix is still on pace for a record year in terms of subscriber additions, and that's really because of the strength of the slate in the second half, and you're going to see a lot of their mega hits, returning series come back to the service. In terms of competition, Netflix pretty much downplayed the threat of Disney Plus, of Apple, of Warner Media, Comcast, and all these other new services that are going to enter the market. What they said was, thanks to this global secular shift in streaming, what we're seeing is that the internet, the pie for internet television is actually growing at an exploding pace, and Netflix is only in a great position to capture a bigger share of the market.
Let's take a listen to Reed Hastings' exact words on competition. We've got this quote from the conference call yesterday.
We mentioned we only win 2% of downloading on mobile. It's like 98% of the time people are not doing Netflix. On U.S. televisions, it's 90% are not watching Netflix. So there's a ton of competition out there. And Disney and Apple add a little bit more, but frankly, I doubt it will be material.
Nick, as someone who used to work at Netflix, do you buy that argument?
Yeah, I do. I think because of the explosion of just internet accessibility across the world, as well as growth in population and overall just consumption of content, the pie is growing. And I think Netflix is doing a really good job of capitalizing on some of that. But other entrants in the market, I think it's far from saturated. So there's still a lot of room to grow.
So how much competition do you think Disney Plus, which has got a huge existing library dating back decades, will actually be for Netflix?
Yeah, so in terms of the content library that Disney's amassed, I think it's definitely competitive. It's also legacy content, so I think that it's really not just about the content catalog that you have to offer, but the content that you continually have coming to the service, right? So as mentioned, the content slate for Netflix is stronger in the second half of the year. I think that continually having that content added on top of the value that's already produced by your library is super critical as well. So I think that Disney's obviously very good at continually having a great drip of really strong content, and that'll certainly provide a lot of competition to Netflix in the overall marketplace.
Now, Geetha, on the call, Reed Hastings and Netflix executives also indicated they were considering a lower tier of pricing. Of course, we know Disney's pricing their streaming service at $6.99 a month. Apple, we don't know the price yet, but how would a lower tier impact the company? Would that get new subscribers, or could it cannibalize the existing service?
I think the lower tier, Emily, will work really well in emerging markets where you have a lot of mobile-only subscribers. I think one of the markets they're looking to make a big expansion into is India, where you're going to have like over 1 billion smartphones in the next 3 to 4 years' time. And the real question is, how do they capitalize on the really explosive growth of broadband in that market? So right now they've made a big bet on streaming in India. They're creating all this wonderful content. Disney is actually quite a formidable opponent in India because it has already something like about 300 million users on the Hotstar platform that it just acquired with Fox. So it kind of makes sense for them to go after, like, maybe introduce a $3 or a $4 monthly plan in some of these emerging markets.
Now, Nick, I'm curious for your thoughts on content. Of course, we know that Netflix has poured billions of dollars into original content. Much of Disney's original content is based on existing hit franchises, hit movies, the Star Wars films, for example. There is, some completely original content, but it's often based on, these legacies that have performed well. Is that really going to serve Disney well going forward, given that the hit shows today are completely fresh, whether it's Game of Thrones or The Big Bang Theory?
Yeah, I think that's a real obstacle for Disney to overcome. If you look at Netflix's content spend today, given the competitive landscape, I think a lot of what I would almost characterize as overspend, they're both spending forward for the consumer base that they will have, as well as spending because I think they get a lot of data that informs what content that they can produce and build new brands and new content that don't exist. And so Disney certainly has a very big competitive milestone to overcome in terms of data collection on their consumer base to help inform what they should produce, what content they should be buying, and what brands they should be building so that they can remain competitive.
But do you also likewise think that Netflix can keep it up? I mean, their hit shows, whether it's Stranger Things or Orange is the New Black, they're still not as big as a Game of Thrones. And in a way, Netflix is making so much, it's almost too much.
Yeah, I kind of think of it as like a hit to non-hit ratio, right? Like right now, Netflix doesn't have to have everything do really well because they're rapidly expanding. They're in expansion mode. They're getting a lot of global subscribers. And so they have a little bit of leeway right now. But I think one of the biggest things that will define their success over time is being able to make that ratio improve so that more shows that they're producing are hits, are brand building. One other thing to consider, too, is something that you would characterize as like a miss. Netflix has a really great way of monetizing more niche content right now because of the data data that they use to target smaller subsets of users across the globe. And so they also have a little bit more variance that they can absorb right now as they kind of learn to be able to create better content over time.
All right, Nick Nelson owns Media, former Netflix, and Geetha Ranganathan of Bloomberg Intelligence. This race is a fun one to watch. Well, the billionaire founder of the company that assembles Apple's iPhones plans to run for president of Taiwan. FOXCONN'S Terry Guo will seek the nomination of the opposition Kuomintang party. He says that a mythical Chinese sea goddess encouraged him to come forward to support peace with China. But what would this mean for Foxconn going forward? Here to discuss, we've got Dennis Wang, political science professor at Sam Houston University, joining us from New York, and here in the studio, our Bloomberg Tech senior executive editor, Brad Stone. So he's clearly positioning himself as pro-China, even with this initial announcement. What does this actually mean for Foxconn?
Well, you don't have to consult the sea goddess, Emily, to know it's probably not great. Guo, legendary business figure, arrogant, swaggering, impetuous, controlling, really synonymous with Foxconn, a $40 billion company that makes the devices that we all hold in our pockets. Everything I know about Foxconn I've learned, by the way, from Debbie Wu, our Taiwan reporter, and she's wrote about how he sort of destabilized the succession question, really kept a control of the company. If something like what happened in 2010 with the suicides at the Chinese factories were to happen again, you need a Terry Guo to lead Foxconn through that. On the other hand, I think of Donald Trump, and the way he is sort of, perhaps not day to day, but sat in the shadows running the Trump empire. I assume that Terry Guo would not completely give up control of Foxconn.
Interesting. Dennis, would you agree?
Yeah, I will agree, but I'd like to mention that it is not crazy to have like a sea goddess to support him, because given the Taiwanese society is very root, it is a spiritual root for Taiwanese society. So I think it's actually a strategic move for Terry Guo to make some kind of announcement like that.
So talk to us about the strategy here, because obviously some people will like that he's pro-China, but that's also could be a disadvantage given the fragility of that relationship.
Yes, indeed. Well, there's advantage and disadvantage. For Taiwanese voters, Terry Guo is actually a figure that indicate someone who's capable of taking care of Taiwan's economic growth. So a lot of people expect him to provide a real solution for the current Taiwan's economic stagnation. So to a lot of supporters, it doesn't matter if Terry Guo is very pro-China or not. They look at the very pragmatic way, look at him as a very pragmatic businessman who can provide solution. But of course, the disadvantage is he's too close to China. Of course, there's some concern about his relations with China. Whether Terry Guo, if Terry Guo really got elected as a president, whether he will be a good, competent communicator, negotiator, or he will become subordinate to China.
Now, Brad, he does have to win the Kuomintang primary first,
yes.
But if he leaves, Brad, what would that mean for Apple?
Well, Apple is Foxconn's largest client. China, of course, is the third, I think, largest market for Apple. Very important, right? When they had to change their sales estimates, their revenue estimates in the first quarter, was because of a shortfall in China. So, Terry Guo moving from a business partner potentially to the leader of Taiwan. I mean, it could have all sorts of implications. Good in terms of Apple's access to China. Perhaps bad if sensitivities around the question of Taiwanese independence, make it back into the U.S. or Silicon Valley, where employees are paying a lot of attention these days to these political issues.
Dennis, given the other competitors here, how do you expect this election, this campaign, to play out?
Well, the current ruling party, DPP, is experiencing a low popularity due to, some would argue, a poor performance. They do have some strengths in terms of improving the relationship between U.S. and Taiwan. In recent years, we can see a lot of, strengthen in terms of the Congress bill passed. the the Asian Reassurance Initiative and Taiwan Travel Act is definitely an improvement between Taiwan and U.S. However, the economic growth, as I mentioned earlier, the economic stagnation is definitely hurting the ruling party. So I will say the current political climate situation is very. It's not very good. It's not look bright for the ruling party. So that's also the reason why there are so many competitors or candidates from the opposition party who's willing to run for the 2020 election.
Fascinating. All right, Professor Dennis Wang of Sam Houston University and our very own senior executive editor and Taiwan expert, Brad Stone. Coming up, it is a breakthrough in modern medicine. An experimental gene therapy has cured 8 infants with a so-called bubble boy disease. We'll bring you all the details next. This is Bloomberg. An experimental gene therapy has cured 8 infants with the so-called bubble boy disease. The immune system deficiency, named for the total isolation affected children were once kept in. Researchers at St. Jude's Children's Hospital in Memphis developed a one-time treatment to correct the defect and were able to build fully functioning immune systems in these infants. Joining us to discuss, Bloomberg senior editor Rick Shine, who worked on this story. So Rick, everybody loves a medical breakthrough. What exactly happened here?
Well, right. You know, it's a great upbeat story at a time when news isn't always so upbeat these days. And some researchers, as you said, at St. Jude Research Hospital came up with a very unique and new way to treat kids, almost entirely boys, who have this immune deficiency. Now, this is something that was tried with some success 20 years ago or so by some companies and some research institutes in Europe. But those children back then always developed leukemia. Now with a new kind of system that St. Jude and a company that is licensing the technology hopes to use, leukemia is no longer a worry.
I'm looking at the chart of Mustang Bio in my Bloomberg here, which was involved in the treatment for this disease. Shares up more than 180% right now, more than 200% after hours.
Right.
You know, these young boys have already been released from their isolation. So, you know, at this point, this seems to be fail-safe. What does this mean for this company and for the industry?
Well, I mean, obviously, it's very promising for the company. The thing to remember is, you know, the news today is based on the results of 8 very successful treatment results of kids that were treated by St. Jude. Now, the company is planning on doing additional research and testing in the hopes of getting fairly speedy FDA approval. Now, whether that's going to happen or not, or how long it's going to take, is still to be determined, of course. But that said, you know, the results are extremely positive. The company is extremely enthusiastic that this will have a good result for them in terms of FDA approval.
All right, well, it's great to hear some good news and certainly miraculous news for these little boys and their parents. Bloomberg's Rick Shine, thank you so much for that update. Coming up, electric cars taking China by storm. There are now over 486 EV manufacturers registered in China, more than triple the number 2 years ago. And sales of electric cars are projected to reach a record 1.6 million units this year. But is the boom sustainable? Bloomberg's Tom McKenzie spoke with William Li, the founder of the Chinese EV maker NIO, at the Shanghai Auto Show.
所以整个中国的汽车市场长期来讲，我还是非常有信心的。
I have confidence in the Chinese automobile market in the long term, but I don't expect the sales of new cars to grow year on year like they did in the past. In general, I think the sale of new cars will be lower, but the intelligent EV car market will be the fastest growing segment.
毫无疑问，在这中间是成长最大的、成长最快的一个细分市场。
they've rolled back some of the subsidies, and that has hurt some in the electric vehicle sector. What do you think is the impact that you're seeing there now, and what is the longer term consequence of this?
The subsidies have decreased since this year, but they're still there. On the other hand, the federal tax rates in China are good for the EV market. There are some benefits of using EV cars, such as lower purchase and consumption taxes, a beneficial license plate policy, and none of the restrictions faced by combustion engine cars in cities like Beijing, Shanghai, Guangzhou, and Shenzhen. I think those benefits will prove to be more sustainable for the EV sector in the long term.
What is the biggest hurdle facing NIO at this stage in the business's development?
How to enhance operational efficiency, how to increase our gross profit, and how to increase our sales have always been the challenges we've faced. In addition, there's the challenge of how to raise funds to pay for more R&D. Those are all things our team needs to be focused on.
There's an expectation amongst many analysts that there's going to be a significant shakeout of the electric vehicle startups here in China. How deep do you think that shakeout goes? How many companies essentially are going to have to be closing up?
I believe there'll be some companies that can survive and achieve success. Just like with startups in other areas, there won't be success for every single company, which is natural.
Tesla expected to start potentially producing vehicles in their Shanghai factory maybe early 2020. Does it change your strategy at all?
We won't change our strategy based on what Tesla's doing in China. The auto market is huge. Tesla is a great company, and it has many good ideas to help advance the EV industry. We certainly have our good ideas too. We would like to move forward in the EV market together.
Bloomberg's Tom McKenzie there with NIO founder and chair William Li. Coming up, he is one of the most powerful people in Hollywood. Our exclusive conversation with Jeffrey Katzenberg on the global streaming landscape, former DreamWorks CEO, former chair of Disney, and Quibi founder. That's next. Now to the future of video streaming with new offerings from powerhouses like Apple and Disney. We spoke to someone who has decades of experience in the entertainment industry for more perspective. In the latest episode of Bloomberg Studio 1.0, I sat down with Quibi founder and former DreamWorks CEO Jeffrey Katzenberg about his new mobile streaming service and his storied Hollywood career.
Well, I think it's early in the game to be calling winners and losers in something that is in sort of almost cataclysmic transformation, where virtually every other day or week, there is something that is a tectonic shifting of the plates. It's a little bit hard when you're in the center of that storm to have perspective on it. Who will be the winners? Well, the winners are going to be the ones that have the biggest and best businesses and have the greatest leaders. And so you can't help but look at and admire what Bob Iger has done.
I was just going to say, is Disney one of those companies?
100%. I mean, he has made what may be one of the boldest, most ambitious bets that anybody in modern business has ever made. They are the #1 company today as an entertainment media company, without peer. Have the best franchises, have the best IP. He decides that the future of that enterprise, of which he's the steward of the moment, he actually has a good deal of humility about it. He realizes he's got the baton, he's going to run with it, and he is going to pass it at some point. And he has decided during that, after 12 of the most spectacular years as a CEO, he's decided to push all the chips in to say, for this company to have as great a future as it has a past, he has to transform it. Bet on Bob Iger.
All right.
No problem.
Would you bet on Reed Hastings?
100%. And I would bet on Steve Burke and Brian Roberts. I would bet on AT&T. These are phenomenal enterprises, great leadership. They are all going to be, in some fashion, shape, or form, it's not clear what that is yet, but they're all going to come out of this with some win.
Do you think content is still king when there is
No.
so much content?
No.
So what makes a king or a queen?
Platform. So I grew up in an era that content is king. Content is king maker, but clearly today, platform is the king. And what I mean platform is, Netflix is a platform. Its content has made that platform successful, but the platform itself is worth $200 billion. So the value of that enterprise is far greater than the content, but without that content, they would not be king.
My conversation with Quibi founder and chair Jeffrey Katzenberg. You can watch our full conversation tonight on Bloomberg Studio 1.0. That does it for this edition of Bloomberg Technology. Of course, we're always live streaming on Twitter. Check us out at Technology and follow our global breaking news network TikTok on Twitter. This is Bloomberg.